Ladies and gentlemen, good day and welcome to Mahindra Lifespace Developers Limited Q1 FY22 earnings conference call. We have with us on the call Mr. Arvind Subramaniam, Managing Director and CEO, Mr. Vimal Agarwal, Chief Financial Officer, and Mr. Sumit Kasat, Head Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Arvind Subramaniam. Thank you, and over to you, sir.
Thank you, Rayo. Good morning to everyone and welcome to our Q1 FY22 earnings call. Firstly, I'd like to thank everyone for pre-registering and participating in this conference call. All of you know this, but for the sake of record, let me reiterate that many of our key operating entities from our residential business, like Mahindra Homes, Mahindra Happinest, as well as our IC and IC business like Mahindra World City Developers, Mahindra World City Jaipur, and Mahindra Industrial Parks are not consolidated on a line-by-line basis. It's customary for me to start with some views on the macro environment. I'm going to skip that since most of you track that far more closely, and I'm going to get into the business end of my opening comments so that we have more time for Q&A. So firstly, it's been, I think overall, a good quarter for real estate in general, despite the lockdown coming from the second wave of the pandemic. The lockdown, by and large, was managed far more systematically by the local administrations. And while we lost much of all of April and part of May as well, with sales offices being shut down, we did manage to figuratively keep our shutters up and continue to clock sales even in that period. So we've ended the quarter with a good rhythm of sustenance sales. What we've not been able to do given the lockdown is to launch new projects in this quarter, and that has been pushed out to Q2 onwards. From a construction activity perspective, when the lockdown was first announced at the end of March, there was a bit of panic among construction labor. Many of them feared that the same thing that happened at the last lockdown, which was a year prior, would happen now, which is long-distance trains would be cancelled, etc. So many of them immediately, within a few days, decided to pack their bags and go back to their villages. But I think confidence built back when they realized that the government stayed true to its promise not to cancel long-distance trains. So we did see a return of labor towards the end of the quarter, and it's built up nicely back into July as well. I continue to remain very optimistic and confident about real estate. Many analysts, including some of you on the call, have been talking about the country being poised for the next upcycle in real estate over the next 7 to 10 years. But from my perspective, let me explain why I say I'm optimistic and confident. 3 factors on the demand side and 3 factors on the supply side that I think plays to this confidence, and particularly confidence for players like us. On the demand side, it's very clear over the past year that homes have become more important and not less important to Indian families. The whole lockdown experience where families have been cooped up in their home 24/7 for weeks at end, months at end, has shown up the compromises that they've been living with. And we are seeing a clear trend towards purchasing a new home. I'll talk about what those trends are, and I see 2 divergent trends there, but I'll come back to that. So that is the first factor on the demand side. Secondly, on our B2B business, our industrial parks business, again, India is poised to find its space as a global manufacturing hub, taking up the slack from China. Now, is this a done deal? Are we already in that preeminent position? Clearly not. But there is a window of opportunity given the shift in geopolitics that India must take advantage of. Some of the policy measures are starting to get aligned to catalyze manufacturing investment in the country, things like the production-linked incentive scheme, etc. And I'm hopeful that those will translate into a surge of interest in India as a manufacturing destination. And third is the formalization of the real estate sector, particularly on the residential side. I'm careful to use the word formalization and not consolidation because I do believe there will continue to be a reasonable tail of developers in each of the micro markets, as we have seen in many other global markets. But market share is clearly consolidating with the larger and more formal, professionally run players. And that is a segue onto what I see on the supply side, which is actually precipitating this formalization. If I think of the three factors of production, land, labor, capital, all of these three are migrating towards the formal sector in real estate. Land availability has never been better. We are seeing a good pipeline, lots of landowners approaching us every week with attractive opportunities that we are evaluating. Capital, as all of you are aware, there's a very significant delta that has emerged between the cost of borrowing and access to capital that players like us have relative to some of the smaller local developers. And that's becoming, particularly given what's happening with the economics of this business, with the IRR focus, the cost of capital is becoming a significant advantage that we can play up. And the third is labor, and by labor I mean talent. Again, real estate historically has not been a talent magnet, but within real estate it is clear that strong talent prefers to work with well-managed professional organizations, part of large corporate groups like ourselves. Let me go back to my comment around the demand and how I see kind of two divergent trends or almost opposite trends happening. I keep getting asked this question by journalists about, are you seeing upgrade behavior? And certainly we are seeing upgrade behavior. We are seeing families wanting to trade up to get more space, better amenities, better quality of product, better locations, as I said, coming out of their lockdown experience. But we are also equally seeing nuclearization of larger families, which is driving the demand for smaller compact homes as well. So the segments that we play in, which is the affordable and mid-market segments, I think across that entire span, we are seeing very deep and robust demand trends. Touching on some of the highlights for the last quarter in terms of our performance, we clocked quarterly sales of 145 crores, and as I said, bear in mind, this is all sustenance sales and effectively around 6 weeks out of the quarter were constrained by the lockdown. So I think that's I'm quite happy with that rhythm of sustenance sales. Within that, the mix was roughly 79% of mid-premium projects and 21% of affordable. But that mix honestly will keep changing quarter to quarter depending on what inventory we have, what launches we do in a particular quarter. Mumbai and Pune contributed more than 50% of that value. As I had mentioned in some of our earlier conversations, those are our two focus markets for our residential business in the years to come. We want to build heft and depth in those two markets. And finished goods inventory was about 12% of that sales value. The average price realization was just under 8,200 per square foot. And we've once again, like we've shown in the last several quarters, had a very broad-based performance where the entire portfolio, from the lowest ticket size at Palghar to the highest ticket size at Luminaire, every single project has clocked sales in this period. We did not do any new launches in this quarter. As I mentioned, given the lockdown, it was not an opportune time to do any new launches, but we do have a strong launch pipeline in the coming quarters, starting with next month itself. We will be launching a project in Chennai, and then following up with launches in every one of our key markets, Bangalore, Pune, Bombay, as well as the third tower at Luminaire in Gurgaon. Land pipeline continues to be strong. I will preempt a question that I know will come about why we've not announced any new deal in the recent weeks. We are very close to finalizing some transactions. The one learning I've had over the past several months is these legal contracts, and particularly joint venture contracts, are littered with more I's and T's than the general English prose. So it's taking us a little bit longer to dot those I's and cross those T's. But I'm very confident that we will stay true to the commitment we've made of acquiring roughly 2,000 crores worth of sales potential, new land opportunities, accounting for 2,000 crores worth of sales potential year on year for the next several years. We're well on track and might in fact be slightly higher than that this year. Collections has been continued to be strong. We've collected 204 crores in the quarter, despite some slowdown in construction activity at the start of the quarter. We did pick up pace and managed robust collections and service. And we handed over about 151 units to customers in this quarter. Completions, we did complete a phase at Avdi as well as Palghar during this quarter. And in the coming quarters, fingers crossed, if the third wave doesn't impact us as a country very severely, we should now start seeing a regular rhythm of completions in quarter on quarter. In the IC and IC business, we leased 6.7 acres for about 14.3 crores during this quarter. Inquiries are strong. The pipeline is strong. The challenge we face there is the restrictions on international travel. Many of our clients are multinational corporations that are seeking to set up or expand their manufacturing presence in India. And for that, the international team is predicated on the international team being able to visit the site and evaluate it physically. We are also seeing a growing traction or growing demand in the IC and IC business from domestic manufacturing clients and also in the warehousing and logistics segment, which is an attractive segment going forward. Let me hand over to Vimal to update on the financial performance.
Thanks a lot, Arvind. Moving on to the financial performance for the quarter 22 versus quarter 4 F21. The consolidated total income stood at 154 crore as against 58 crores in quarter 4 F21. The consolidated EBITDA including other income and share of profit from JVs stood at negative 17 crores as against negative 30 crores in quarter 4 F21. The consolidated PAT after non-controlling interest stood at negative 14 crores as against negative 27 crores in Q4 FY21. The company has a debt of 255 crore at consolidated level as per Ind AS, while cash in hand is about 162 crores. Cost of debt stood at 6.95% on console level, while standalone cost of debt for MLDL stood at 5.9%. Thank you. We can open the floor for further questioning, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Adhidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, good morning everyone. Firstly, I'd like to congratulate you on announcing the bonus issue. I have a couple of questions. The first question is for our launch plans for this year. As you mentioned, we're launching in almost all our markets where we are present. So have you frozen on the area you'd like to launch for the year cumulatively as a whole across these projects?
Yes, we have. I don't have the number offhand, but we can put it together and share it with you. In each of these, so it will be I would say the first phase of each of these new developments would normally be between 30 and 50% of that total saleable area in those projects. And in places like Luminaire, for example, is the third tower out of third and last tower, so it's 1/3 of the overall saleable area. But generally, between 30 to 50% of the saleable areas will be brought to market together.
So at least, just again, sorry to follow up on, at least it would be 1,000 crores, the value of the inventory which we will look to launch for this year.
Oh yes, actually in excess of that.
Okay, okay, boy. Secondly, this is a question for Vimal. I was referring to your presentation on slide 35 for the segmental performance. Your gross margin for the residential business seems to be low at 7% for this quarter. So I understand you're following project completion, but any specific reason why it is appearing lower?
No, there is absolutely no specific reason. What happens is this is the sort of one of the tower which we have completed in one of our Pune project. The total profitability of that project is upwards of 20% gross margin. Okay, it's largely driven by the allocations which we keep doing, but at an overall level, this project will deliver a gross margin profit of upwards of 20%.
Sorry, sir, just missed the Pune project you said, or which one?
That's right.
Okay, so I didn't get it. It says you are booked it for the first time. Is it that is why, or
sorry?
What is it? No, I'm saying why is it appearing?
Usually because it's a large development, and I'm talking more specifically for NCR project. Because it's large development, there are common infrastructure which you end up developing, and the allocation is not completely in sync at tower by tower level. So the project once completely developed, handed over, will give us a return of about 22.5%. This specific tower is slightly low on account of allocation.
Okay, because the infra. Okay, got that. Okay, fine. I'll come back in the queue with more questions. Yeah? Thank you.
Thank you. The next question is from the line of Rohit Poti from Marshmallow Capital. Please go ahead.
Thank you for the opportunity, and it's always a pleasure to hear your commentary. My first question, so what I understand is that at a government level, they're looking to unlock the vast tracts of land that is available with PSUs currently, and there's talk of setting up SPV, etc. And most of these lands are at prime locations in the metros that we are operating as well. So I'm just curious to know, do you think the supply of land could reduce prices, and is there any risk from that end? And are we looking at these parcels aggressively also?
Thanks, Rohit, for that question. So, look, as I mentioned in my opening comments, land supply is only growing. The PSU divestment is one source of that, but there's also a lot of stuck assets with the NBFCs and banks that are coming into the market. Landowners themselves are realizing that the surety of working with the larger developers that they get in transacting with us is kind of attracting them to approach us with their land rather than try and either develop it themselves or with local developers. So on multiple fronts, we are seeing a very strong supply side on the land side. So we have to pick and choose what meets our needs and what we want to focus on. As I had laid out earlier, our focus markets are Mumbai and Pune. For the next 3 years, we want to double down on these markets. We also wanting to pick up land which is ready to market. So we're not looking at things that are futuristic demand centers. Our entire operations engine, economic engine is geared towards acquire the land, bring it to market quickly, sell quickly, construct and deliver quickly. So cycle the entire cash cycle, accelerate the cash cycle. And therefore, we have to view these opportunities with that lens. If it's a very large land parcel, we will be more cautious. I'm not saying that we will sit out of large transactions. We are evaluating them very selectively, but it needs to make sense from a strategic perspective and fit with our economic model. We're not going to go berserk trying to land bank just because land is available cheap.
So small follow-up, is there a risk to price, price correction if this land supply comes, do you see a price correction in housing units because of this huge land supply which can reduce the cost of land?
Actually, and the markets that we operate in, which is in the city of Mumbai, we operate in suburban markets in Pune, all over the city. Land cost is typically 15 to 25% at most of the top line. So even if land cost reduces by 20%, you're talking about a 3-4% difference in margin. I think this is a misnomer and a myth that land cost drives prices. It is much more about design, speed to market, and the carrying cost of the land rather than the cost of land itself. So if I buy large tracts of land which I can't take to market for 4 or 5 years, that is where cost builds up and the pressure on pricing comes in. And today, given what's happening on the input prices, commodity prices, steel, cement, copper, plastics, etc., the conversion cost of land into final product is where we need to pay far more attention than the cost of land itself. And look, none of this is to take away from the fact that we need a good deal on the land. But that is no longer, to my mind, the single most important swing factor that determines pricing and viability of projects.
Perfect. So my second question is, so in some mature markets like US, we see many of the home builders shifting to they fix the price in the beginning, they take 10% upfront, and they take the remaining, let's say 80-90% towards the end of the, when the project is completed. And I think 1 or 2 developers in India, the large developers are also sort of bringing in that model. Can you speak about that? Do you see that as a risk to our IRR approach that we're taking right now? And do you see anything like that happening in India on a larger scale?
Yeah, look, I think that's a very important driver of how the economics of this segment will play out. Historically, as all of us are aware, residential real estate has been funded through customer advances, right? So, and therefore the construction-linked payment plan is very important. How much you can construct, how quickly you can construct, and demand that money from the customer. It drives your economics. Combined, of course, with sale, you have to have sold to be able to demand. If that changes to a lot more of the back-ended payment plans, the 20/80, 10/90, etc., it brings into question the very economic engine of the residential real estate business in India. And we are seeing that happening, particularly in the higher ticket size segments. So in the luxury market, 5 crore plus, there is a tendency for customers to demand that, as well as the developers are setting up those kinds of payment plans. We are still not seeing that as a very prevalent trend in the segments we operate in, which is roughly 30 lakhs to 3 crores. I think customers there are still willing to live with construction-linked payment plans. They realize that, look, if we do a 20/80, it will come at a higher price. And given that mortgage rates have come down, customers are making the trade-off. It's also about them splitting their cash flow over the 3 or 4 years of the construction period, rather than having to cough up everything upfront. So far, we are not seeing this as a big trend. That being said, I think your point is very important. It's something we constantly evaluate, which is in the mid to long term, if this shift happens more broadly in the segments that we operate in, how do we need to retune our economic engine to still be making good IRRs and margins in that environment?
Perfect. Sorry. My last question is, could you give us a broad breakup of the 3 major cost heads that we have in each of our projects, which is, I believe, land, labor, and material cost? Labor and construction material cost.
So as I said, land is roughly between 15 and 25%. If you add approvals to that, the various premiums, etc., it will be between 25 to, very rarely does it even touch 30%. Construction, again, depend on segment and location, would vary between 30% to 40% of the top line. And the rest is then gross margin and overhead.
So of the construction, what would be labor and what would be material?
Labor will be closer to 40, I guess.
Labor is about 40%, material 60%.
Okay, thank you. That's it from me. I'll get back into the queue.
Thank you. The next question is from the line of Himanshu Upadhyay from PGIM Mutual Fund. Please go ahead.
Yeah, hi. My one question was on the land bank, the slide what we have given, it is slide number 29, okay? So we have talked about SEZ of Mahindra World City, Chennai, okay, residential zone. But anything change you are seeing on Jaipur side? Because we have not discussed here. And there is also a large component of residential and social on Jaipur. And how far away is that from getting launched, or we starting to do some residential or something on that land in Jaipur? Can you give some light on that?
Yeah, so the social and residential zone of Jaipur, we are hoping to bring to market in the next financial year. We've started some planning on that. But it will really depend on how Jaipur as a residential market plays out. It will be a new residential market for us. We've not done residential developments there, so we are studying the market carefully to understand what kind of product to lead with, so that we establish the location, establish a certain clientele for that location, because this is a suburban location from a Jaipur context. So we want to create it as an attractive residential destination. We need to lead with the right product segment. So that work is underway. Hopefully in the next financial year we will start making the first set of launches there.
Okay. And one more thing. We were earlier saying that we want to be in Bangalore, Pune and Bombay, okay? So in this call, what we are saying is that only Bombay and Pune is the markets where we want to focus on. Is it right? Means that
let me clarify that.
We want to further narrow down?
On the last call as well. Bombay, Pune are the markets where we will have portfolios of projects, multiple projects at a point of time. We do like Bangalore. We've done a very successful project there, Wind Chimes, which is now completed and fully sold out. We are doing another launch there in the coming months. Bangalore, we will, for the next 2 years, treat as kind of a beachhead market. It would be very likely the third market in which we would like to build a broader presence. Therefore, we don't want to vacate the market. We will continue to do perhaps one, at most two projects at a time in Bangalore, versus Mumbai and Pune, where our intention is to do dozens of projects. So that's the distinction.
Okay. And this one thing, one of the competitors was being very bullish on the NCR market. Are we seeing any traction in our luminaire, which is a high ticket item, and can we launch also the next phase of luminaire in this year? So anything on that luminaire project which is there?
Yes, so as I said, we do intend to launch the next phase, which is the last phase actually, the last tower later this year. And we are seeing good traction on sales. In the last financial year, we sold out Tower A, and we are making good progress on Tower C as well, which is the second tower that we've now applied for OC for that tower. So as soon as OC comes, we expect to convert a lot of the inquiries into actual sales.
One last thing. This Mahindra World City, are we seeing any traction? Because on the manufacturing side, or what we said that last year also in the AGM we stated that business we see should show a decent traction. But in terms of inquiry and all those things, what traction are you seeing? Because we see some amount of travel has also started and vaccination and all that. But on ground, are you feeling that that business, what we were expecting to do last year, is now getting the traction and we can increase the sales multifold from here on in that?
That's a candidly, I'd say yes and no. No, because I would certainly like it to be many times larger than it currently is. But I do recognize, and we must all recognize the challenges that business has. It's a B2B business. The sales cycles are very long. And it takes 9 to 12 months to convert an industrial client into who's trying to buy a factory location. As I mentioned, we have a reasonable pipeline of inquiries. Conversions have been constrained because of international travel being limited. The domestic clients we are still able to convert, but that's a smaller proportion of our business so far. Going forward, that too will change as we see the demand for warehousing logistics picking up. We are seeing a lot more domestic business in the pipeline. We've also recently brought on board a new leader for that business, Rajaram Pai, as the Chief Business Officer for our industrial business. And that's a signal of our kind of intent and commitment to grow that business.
Okay. One small thing. This Ghodbandar Road, what are the pending approvals there? And do we expect that we can launch in FY23 onwards? Just update on this land.
So FY23 is the target to bring it to market. There are multiple tactical approvals. There is zoning change, there is NA conversion, there's a sequence of steps we need to go through. Most of them are procedural. We don't see it as being a significant bottleneck, but they take time. They need to be done sequentially, and that's why F23 would be our target to bring that to market.
Okay, thank you from my side.
Thank you. The next question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Hi Arvind. Congratulations on a decent performance. So my first question is on the industrial land. So you have added this Gumri Kundi land Origins Phase 2. So just wanted to understand which all other industrial lands you're looking to add or expand, given that you are seeing a robust pipeline there, and as the travel opens up, the traction could build up.
So industrial locations are our 4 established locations, which is the 2 world cities and the 2 origins. And as we've mentioned in the past, we are aggregating land near Pune for another origins park there. Beyond that, there is no other plans to create new industrial parks at this point of time.
Okay. So within, say, Pune is more of a urban-centric location. So do you think that potentially if this 500 acres which is there, so part of that can be converted into residential if we see a potential and maybe give us better yield?
Not in that location. I mean, that is an industrial location. It is, there'll be some small amount of affordable housing one can do there to service the manufacturing workforce there. But I don't see that as an attractive residential location for the next few years.
In terms of pricing of these industrial lands, are they significant premium to the government, the land the government allocates to industries, or is it? So how do you benchmark the pricing here? So do you think that the demand going up, there's a potential for that our land is undervalued and maybe can significantly re-rate on the pricing side?
No, so in fact, at the 4 existing parks, if I were to take the pricing, it is significantly higher than the government land. So whether it is SIPCOT in Chennai or GIDC in Ahmedabad or RICO itself in Jaipur. But the proposition is very different, I think, and clients are able to see the nature of, shovel-ready land with infrastructure done, green certified. I think that's becoming very important for many of the clients that the facility is sustainable and green. And we have been pioneers in that for many years now, and not just paying lip service to it, but Chennai, for example, recently got zero waste to landfill certification. It's the first large development to have that in the country. Jaipur is on the C40 cities list. So, these are things that are were at the time far ahead of their time, but today are becoming almost gating criteria for clients to make their investment decisions. And I think, therefore, they are willing to pay that premium. Also, if one were to step back and see what is the cost of land as a proportion of the overall establishment cost of a new factory or a new business in India, it is not that large. So while every client, of course, will want to negotiate to get slightly cheaper land, it doesn't swing the economics as much as many of the other things about, will I get my approvals in time? Is the infrastructure ready? How quickly can I go to market? I think those are bigger decision criteria.
Okay. So one question for Vimal. So Vimal, we have been reporting losses for multiple quarters now. So when do we think we can come back in the black? From which quarter or from which financial year our EBITDA will turn positive, or maybe at the PBT level will be positive?
Frankly, Pratik, I'm sure you have seen the overall assets which we have in the balance sheet, and from that perspective, I'll take it in 2 parts. One is the doability per se. We strongly believe that that is definitely sort of achievable in the short term. One example which you just spoke about, Arvind mentioned about, is say the Ghodbunder land. Now it has got multiple layers of approval, but the pace at which we are moving is very comforting. What it means is we are definitely heading towards better times. Now, in terms of red or black, I'll say that it can be black very soon. Consistency and uniformity is what we should be focusing on. That's the key point for us.
Yeah, Parikshit, we've talked about this in the past and last call as well. I think it's important that we build this in a sustainable and steady manner so that it moves in one direction. What I don't want is a flash in the pan. One quarter we suddenly show some bumper profit, then again slip into loss, etc. But that being said, I think in the next few quarters we will definitely be looking to turn around the business into the black.
Just last question on the land aggregation side. So we've been hearing, and now earlier today in the call you said that we are in excess of 2,000 crores. We remain committed to closure of the land. So have you seen MOUs already in place for this? And just because that last bit that the first payment goes out to the landowners, then you announce it. So in terms of timelines, is it like 3-4 months away from these? And second thing is, in terms of overall pipeline, have you seen the gross market value of land deals which you are pursuing? So has it been swelling up over the last few months, given that you said that you are seeing a lot of land coming to the market? So beyond this 2,000, have you already started working on due diligence and initial deliberations on for the next pipeline? That's the last question.
Parikshit, in all our competitive exams, we had always these multiple choice questions, and the last choice was always all of the above. So I'll say all of the above as an answer to your question. So yes, certainly we are seeing, as I said, a strong build-up in land inquiries that we are getting, and therefore the GDV that we are evaluating is actually far in excess of the 2,000 crores. What I want is to make sure that we get 2,000 crores of very attractive, ready-to-market land that meets all the parameters that we want, and therefore we will always have a hopper that is much larger than that. But as I said in my opening comments, I do expect that we will end up a little bit north of 2,000 crores this year. There's some very nice deals that we are in advanced stages of. We do have MOUs in place, and as I had mentioned in some of our earlier calls, I don't want to jump the gun and announce those until we sign definitive documents, which is why it's taken a little longer.
Okay, just on the bonus part lastly, so congratulations for announcing it, but just wanted to understand your thought process, because this is our maiden bonus which we have announced. So besides behind that, what has gone behind the thinking of announcing it, the first maiden bonus for the group, the Mahindra Lifespace? If you can just touch upon that. So what was the thinking about?
Yeah. So I'll link it back to the earlier question you asked about trajectory on profitability. I think the thinking is very simple. It is to signal to the market, to investors, to all of you that we are confident that there will be good times coming very soon, and we are able to, therefore, a larger equity base. Because the last few quarters we've been reporting a loss, there's been no dividend distribution on account of that. We felt it is important, and we have a very large reserves to paid-up equity ratio. We felt it's important to give our investors confidence that we see a brighter future, and that's the primary driver of the bonus issue. Tactically, there was also feedback from several investors that the liquidity in the stock was constrained. Investors were not finding enough liquidity in trading. Hopefully, the bonus issue, empirical evidence has shown that that should also increase the liquidity in the stock.
Okay. Thank you. Thanks a lot, Arvind, and all the best to you. Thanks.
Thanks, Parikshit.
Thank you. The next question is from the line of VP Rajesh from Banyan Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Question is,
Mr. Rajesh, we can't hear you. Your voice is not very clear. If you're on a hands-free, request you to use the...
Is it better now?
Yes, sir. Please go ahead.
Hello? Yeah. Okay. So, Arvind, first question is on the land prices. Are you seeing them moving up in comparison to, let's say, 6 to 12 months ago?
No, quite the contrary, actually. I'm seeing land prices softening because there are fewer buyers in the market, particularly on outright transactions. There aren't too many developers who are ready to put payment up front. And therefore, for us, we are seeing more attractive deals in the market. And as I have mentioned in some of our earlier calls, we are actually seeing land transactions that we had lost a year and a half, 2 years back, coming back to us on more favorable terms today.
Mm-hmm. Wonderful. And on the selling of apartments, because the commodity prices have gone up, are you guys thinking about increasing the prices, or how are you thinking about passing on that cost?
Yeah, so look, we are putting in a discipline where we will increase prices across our portfolio. Of course, the extent of increase varies depending on the specific micro market, how our project has performed, what is the competitive intensity, etc. But even separate from the input cost inflation, we are on a steady path to increase prices quarter on quarter, and I think that's very important from a perspective of how our economics are set up. If we want customers to buy early in the project at a pre-launch or a launch, the only economic rationale for them to buy early is if the price goes up, right? So we need to be able to price it at the level where we can have a steady increase quarter on quarter, year on year. And we have demonstrated that across our portfolio, even through the last year and the last 5 quarters, including this.
Right.
Please stay connected. We seem to have lost the line for the management. Please stay connected while I reconnect the management line. Thank you for patiently holding your lines. We have the line for the management reconnected. Over to you, sir.
Yeah, sorry, I don't know which part of my answer I got dropped off on, so let me wind back. You asked about pricing. Look, I think there's 2 aspects to pricing. Right. One is certainly how do you take care of the input costs, and therefore a cost plus approach to pricing. But there's also a market-based approach to pricing. And from a market-based approach, what we are wanting to do, and we've set ourselves up for, is quarter on quarter across every project, we do want to be able to increase prices. And it may be smaller, it may be larger, depending on the specifics of the micro market, how our project is performing, what the competitive intensity is. And I think it's heartening that over the last year, the last 5 or 6 quarters actually, we have been able to do that. So even in a tough year like last year, we were able to increase prices anywhere between 2% to 8% across our portfolio. In not a single project have we had to cut prices. So we've been able to maintain that discipline. Now there's the additional factor, as you mentioned, about input costs. So that will also drive us to continue to steadily build up price.
Right. No, that's great. My last question is on the Gurgaon market. So after the success that we had with the current project, are we looking to vacate this market, or are we going to build more here?
For the time being, Luminaire will be our only project. We are, as I mentioned, we're launching the 3rd tower that will take us probably 3 years to construct and complete. So for that period, we continue to stay in that market, and then we'll take the call. The idea is to focus on a few markets and build depth. So those are Mumbai and Pune, and as I said, we will maintain our beachhead in Bangalore. Gurgaon, we will come back to in 3 years' time once we are closer to completion of the Luminaire project.
Great. All the best. Thank you so much.
Thank you.
Thank you. The next question is from the line of Prem Khurana from Anand Rathi. Please go ahead.
Yeah, thank you for taking my question. So 2 questions. So first one was on the Mumbai real estate market, and if you could share your thoughts on the way the market has been behaving after the stamp duty benefits have been taken away, and if you could kind of link it to your projects, Vicino and Alcove. How has the footfall been after the stamp duty waiver has been taken away? Because when I look at the registration number, it seems that the numbers have come off quite significantly.
Yeah, so look, actually, I was also worried that once the stamp duty benefit gets withdrawn end of March, that there will be a sudden drop in sales. And unfortunately, that did coincide with the lockdown. So April, May was slower from an inquiry perspective, but it has built up nicely since then. Second half of May and into June, sales have built up very nicely, which indicates that the market has moved beyond that stamp duty reduction. Also, from a actual economic standpoint, if you look at it, a 2% stamp duty reduction, I mean, many developers were offering those kinds of discounts across the table. So rationally, it should not make a difference to buying behavior. Of course, there is a large signaling value when the government reduces stamp duty. It does create a impetus for customers to buy and buy quickly because there was a deadline to that. So I do understand that, but it takes whenever these things have happened in the past, it takes a few months to unwind itself, which we are clearly seeing. I don't think any customers have that overhang now that stamp duty used to be low, and is there an expectation that again there will be cut? We are not seeing those conversations from customers or those expectations from customers.
Fair to assume, are you happy with the kind of response that you've seen for Elco? I mean, I understand April, May would not be the right months to kind of look at, but given the fact that we've already we've already had June and then spent some time in July as well, and the way the footfalls have been or the walk-ins have been at Elco, which, are you happy with the run rate?
I'm quite happy because let's take specific examples. So Alcove, we are currently sitting at about 50% sold of the phase that's launched. Now, we also have to bear in mind that our portfolio will comprise different kinds of projects. And not everything will be a Tathawade or a Kalyan or a Palghar. There will be projects that will be very high velocity upfront. There will be projects that we have to steadily work through. Alcove is one such project, which is a similar project. We are seeing week on week walk-ins. We are seeing conversions happening every week, and we have to be steady in how we build those kinds of projects. Particularly, Alcove is a very sharply targeted kind of product. Typical, our audience is largely from that pin code itself. So it's a very narrow geography, which is the addressable market. We have sized the project appropriately, and therefore have no worries. It is tracking to our investment case.
Sure. And so on this, so given the fact that there are too fewer buyers these days for land pass, which is you're getting more transactions come your way. Has that changed? The way we approach these new projects. In the way we kind of underwrite these projects in terms of let's say IRRs, or let's say in terms of the gross margin or project level margin that you would expect, or it still is still working with the same number that we used to have earlier.
Look, we have inched it up, to be honest. Given that we are seeing more supply of land in the recent months, we have taken our hurdles up from where they were a quarter back. But it's not a dramatic change. It's not like we've doubled our IRR or profit expectation. It is few percentage points increase, and we'll keep refining that. It's always a balance between what we see as supply, how we see the marketability of those projects, etc. But I think today we have the confidence of setting slightly higher hurdles than we did 3 months back.
And just one last, just want to clarify with them, and I've been kind of grappling with this issue for a while now. And so when I speak to people in the market, when I look at, let's say, all of us, our peers as well as us, we've been talking about seriously big numbers in terms of scale, right? We are at around 1,000 odd crore rupees today in terms of sales. We are targeting 2,500 crores, and some of our peers have similar kind of targets, in terms of growth prospects. And obviously, if most of us are looking at this kind of number, we would be required to buy land, which is where, there will be demand for more land, right? And at the same time, we've been talking about, no change in land price, or rather softening of land prices. And when I look at SIDCO auctions, you get to feel there's still competitive intensity in the market where people are willing to pay top dollar to be able to buy city-centric land parcels. And we are looking at city-centric land parcels, right? Because the idea is to kind of reduce land to launch timeline. So how do I marry these two things? Essentially, we're looking at higher underwriting, thresholds, and at the same time, there's demand for more land, because most of us have been talking about seriously big numbers in terms of scale.
Interesting dilemma you've posed there, and I do understand where you're coming from. Look, I think, firstly, with all humility, we are a fairly small player. So for us to grow from where we are to 2,500 crores, I don't think supply either or market size is the constraint. It is our internal ability and our conviction, our discipline to build the business in the right way that is going to be the determining factor of that. So, whenever my team or others come to me and say, oh, but, market has grown by so much, shrunk so much. When you're a single-digit market share player, honestly, you're not driven by by how big the market is and whether that has grown. Similarly, on the land side, all we are looking for is 3 or 4 land parcels aggregating to 2,000 crores. We are seeing deals which are several multiples of that. So I don't see any reason why we can't execute 4 land parcels worth 2,000 crores.
Sure. Just one last bookkeeping question. Vimal, if you could help me with the revenue breakup, the project-wise breakup if you have, the top 2-3 projects.
Yeah. You're referring to the residential side of our business, right?
Yeah, so the 150 odd crore rupees of revenues that we booked during the quarter, the income statement number.
So about 70% is coming from our Pune project, and the balance 30% is split between 2 or 3 sites, actually 2 sites. One is Avti and one is Palghar, in equal proportions roughly.
Palghar, would that form a part of the top line? I thought it's a part of associate company.
You're referring to India's numbers, okay. Yeah, so it's only the Avti project which will come there. And there were a couple of other finished goods transactions which would have happened, but that is very sort of small portion of the entire number.
Okay, sure, sir. Thank you.
Thank you. The next question is from the line of Anish Jobalia from Banyan Capital Advisors. Please go ahead.
Yeah, hi, good afternoon, and thank you for the opportunity. Hope my voice is audible to you. So, just wanted to continue from the last quarter when we are kind of thinking about launches being to the level of around 2 million square feet. So, in this year, so are you on track to do this, and what's the kind of expectations of the sales that you have penciled out for this year? If you could provide more color, that would be helpful. Thank you.
Yeah, so we are on track for all the launches that we had planned for this year. As I mentioned, there was a launch planned in Q1 which got pushed out to Q2, so we have a little bit of bunching between Q2 and Q3. But we will manage that and make sure that all those planned projects get launched. I won't share a guidance for sales for this year. As I said, I prefer to share midterm kind of targets, which is our 2,500 crores by FY25. You can do the interpolation from here to there.
Right, but just to think directionally, like in FY19, our launches were like around 1.55, and this year, the launches are expected to be higher than that. So, can we kind of expect to kind of cross the FY19 sales number in this year itself? How to think about this direction?
I think good question. I will not, as I said, I don't want to share guidance for short term.
Okay. And the second question would be, if we look at our sales per square feet, this quarter it's higher, but let's say we take the average of the last 4, around 7,000 rupees. So how would you break this into gross profit per square feet and, let's say EBITDA per square feet that we realize on every new sales that we book incrementally?
Vimal, you want to take that?
So at an overall level, a couple of points. One is affordable and mid-premium. In both the segments, we have seen that the gross margins are not significantly varying. And from that perspective, our target will be to have gross margins upwards of 20%. Affordable may be a bit lower, but that really depends on the geography, location, and your target segment or the timing of the project launch per se. But directionally, that's the number you can keep in mind, which is closer to 20-22% gross margin.
And how do you further translate into, let's say, after taking off the other expenses or the common expenses also?
Our projects will be in the range of mid-teens for PBT margins and early 20s or high teens for the project IRR, and therefore equity IRRs in the low 20s.
Okay. And just one question around our target of 2,500 crores. So, even today, whatever sales we show, number, so there also we kind of have sharing with our JDA and other partnerships. There are so many partnerships that we have, right? So, going forward incrementally, out of the 2,500, so whatever we are doing today, let's say 50% of that would be belonging to us. So, let's say when we reach 2,500, do you think that this is like the share of our ownership of the 2,500 crores will keep inching up on the basis of your strategy of outright purchases, etc.? Or, how to think of it?
2,500 of our sales.
Of just our sales. So, but sir, today whatever number you show, that is between us and our partners, right? We say 145 crores that you show in this quarter. That is between. Is it just our part of the sales, or is it along with the partners?
No, the other way to look at it is so say from financial point of, ultimately you have got one top line and one bottom line to deliver. If your overall land prices are baked into your cost of sales, which is middle of the P&L, to that extent, your bottom line is not getting impacted. So it's like saying that my cost lines will get muted to some extent, and to that extent, my top line is also getting sort of reduced. And therefore, my size of the P&L will reduce, but the bottom line is what I am ultimately going to deliver, irrespective of whether this is JDA or a full ownership or a greenfield project.
So, okay, so I mean, probably I'll take it offline, but just to understand, you are saying that the bottom line that we'll make would be on 2,500 crores of our sales, right? I mean, that's what you are trying to say.
No, I am saying the bottom line which comes out of 2,500 crores, irrespective of whether it's a JDA or a full ownership model, will get delivered.
Okay, fine. Thank you so much for your time and all the best.
Thank you. The next question is from the line of Manish Agarwal from JM Financial. Please go ahead.
Yeah, hi. Good afternoon. So my question is related to the land inventory slide. So till the last quarterly presentation, we used to give land inventory of 5.74 million square feet. But over here, this time around, it has been converted into acres. So is the potential same, or can it go higher? This is MWC Chennai residential zone I'm talking about.
Sumit, you want to take this?
Yeah, hi Manish. So I think given that we have not assessed the entire development, building plans have not been applied to, hence the square foot number has been not mentioned, but broadly it is expected to be 5 million square foot for that 114 acres that you are seeing there. Mm-hmm. We plan to convert some bit of land into industrial end use because Mahindra World City as a location, industrial land has a higher demand. We are not able to service that demand because we don't have land to offer. So part of the land is planned to be converted as industrial end use. We have made some applications there, and in the balance land, we do expect about 5 million square foot and above development potential. Having said, it will also depend on the development format. For example, if it's a plotted development, obviously you don't use the entire FSI, right? So those formats will decide what's the overall development potential that we will eventually realize.
And any launch timeline?
We are launching one affordable project there, which we have mentioned in our to be launched pipelines, MWC residential. That's 4 lakh square foot. That's the immediate launch that is being targeted. Beyond that, affordable is a work in progress. Plotted is a work in progress. Expecting a launch either towards the end of this fiscal or early next fiscal on plotted bit.
Okay. Secondly, on the Ghorbandar Road land, what is the total developmental potential and how would it break up into commercial and resi?
Too early to comment on that. It's still in planning stages and there are multiple options in terms of what is the asset mix that we are in the process of evaluating. So, we'll probably be in a better position to answer that towards Q3 or Q4 this year.
Okay. And lastly, the MWC outside boundary land, which is 64 acres, is planned as land sale. So this will be as industrial land sale or outright land sale? And who would be the buyer in case it's outright?
So this would be outright land sale in most cases. These are typically disparate pieces of land that, when you do land aggregation, you have a certain, you end up with kind of disjointed pieces of land around the main core area that you're trying to aggregate. So these are those kinds of parcels, and it is typically local buyers for various kinds of needs. Some people buy it for local housing, some people buy it for setting up workshops and showrooms, there is retail, there's no one end use that one can think about.
And realizations would be lower than the industrial land selling.
There's also no infrastructure we've developed here. These are sold as, with no linkage to the main world city. And therefore it's an as is where is land sale.
Sure. That's all from my side. Thank you so much.
Thank you. The next question is from the line of Nikunj Maheti from Quest Investment. Please go ahead.
Hi, good afternoon, sir. Thank you for the opportunity. My first question is with regard to the Origins Pune. So, how much land needs to be aggregated further, and are there any risk of delay with respect to the timeline of the launch, which is into this, which might be because of the aggregation of land that can come up?
The Pune project is going to be an Origins format. So our Origins formats are typically in the range of 400 to 600 acres. So that is what we are aggregating there. There is still some part of that for a contiguity and for master planning that still needs to be acquired, which is what we've disclosed. Around, I would say 70-75% of the land is already acquired. About 25% still needs to be acquired.
Okay. But my follow-up on that is that will that 25% of the land be smoothly acquired, or can there be risk of delay on that?
Look, there already have been delays, right? So, and land aggregation is never a predictable linear process. There are several interdependencies, etc. But look, I think we've crossed the hump on that, and we expect that over the next 3-4 quarters, the key parts of that land as well as the access to that land will all be sorted out. So we are on track for what we had said.
Okay, got it, sir. So my second question on the IC and IC front is that you mentioned that other than Origins Pune, you are not looking to add any further land into the IC and IC segment. So we had this MOU signed with the Gujarat government for the Dholera project. So could you throw some light over there, and is there any timeline within which that MOU has to be completed?
No, so we will not be proceeding, as I said, with anything beyond the 4 existing parks and Origins in Pune. These are the only 5 locations for the next several years that we'll be focusing on.
Okay, got it, sir. Moving on to this B2C segment which we have. So if I look at the presentation and get the data, so affordable housing from the new projects, from the new land which we have acquired, is roughly 53%, and mid premium can be 47-46% range. So going forward, what would be our strategy for the new land which we acquire with respect to the mix of affordable and mid premium, and how are the realizations likely to change after that?
Yeah, look, we don't approach this the residential business with a presupposition or a certain quota saying I want so much for mid premium, I want so much for affordable. That is an outcome of the particular land location and the understanding of the market. So we have, for example, in certain markets which could traditionally be seen as mid-premium markets, we are planning affordable products because we feel there is a gap in that segment, and vice versa as well. So it's led with what is the land opportunity and what is the right product there. It is not led with saying I want to build a certain amount of affordable and a certain amount of mid-premium.
Got it. Lastly, a question on the expected quantum of outflows which are likely to happen because of this every year land acquisition. So what would be that quantum be, and how are this likely to be funded with respect to the debt and equity ratio which we are looking at? Is there any stringent net debt target over there, net debt by equity target over there?
Yeah, so look, let me put the numbers very simply to you. We want to do 2,000 crores worth of sales potential in terms of land acquisitions. Land is roughly 20-25% of top line. So land outlay in that will be about 400 to 500 crores per annum. 400 to 500 crores does not get all paid up front. Most of our land transactions are with staggered payments where most of the payment happens closer to approvals and to launch, even in the outright case. And some proportion of that will be joint ventures in various forms which don't require that kind of upfront capital outlay. So net, I think with about 400-500 crores of land outlay year on year for the next few years, we will be well on course to get to the targets we've outlined. That can comfortably be funded by internal accruals and a little bit of debt. We don't want to go overboard on debt. I think getting to even 0.4, 0.5 of debt equity is more than enough for us to fund that kind of ambition. Now, having got there, we will of course want to raise the bar. It's not for all time that we will want to be at 2,000 crores or 2,500 crores of sales. We will systematically keep raising the bar in terms of our growth expectation. So at that stage, we will see. By then we will also have even stronger reserve base, etc. So I don't expect us to be a very highly leveraged company. We will be quite prudent on debt. But we won't be zero debt either. We will be smart about taking debt where it makes sense.
Okay. So there is no specific debt equity ratio for the sources of fund which you're looking at, right? If I read into it.
Yeah, as I said, I would be comfortable with a 0.4, 0.5 debt equity ratio. I think we have enough ability to service that kind of a debt equity ratio. Above that, I would be very cautious.
Got it, sir. Thank you for answering my question, sir. Thank you.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to Mr. Arvind Subramaniam for closing comments.
Thank you, Rayo, and thank you everyone who participated on the call and for your questions. Look, I think just to sum up, it's been a good steady quarter, neither extremely good nor extremely bad. Given the circumstances of the second wave and the lockdown, I'm very happy with how the quarter has played out. And the confidence in the coming quarters and years remains very strong, and if anything, the conviction has only grown deeper. In both the residential business as well as the industrial business, we expect to rev up the growth engine considerably in the quarters and years to come. I think, as was asked and I answered, the bonus announcement is a signal and kind of a statement of confidence that we are making to the investors in the market, saying we do expect good times ahead. With that, thank you all and stay safe.
Thank you very much. On behalf of Mahindra Lifespace Developers, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.